Hi, folks. This is Sean Hyman from Chart of the Day, and I'd just like to welcome you to our new 2-day-a-week format. And I want to talk to you today about common trade setups that I look for in my currency cross trading service. And uh, there's several different patterns and things that I look for. I look for things that we've talked about before, like double tops, but only once they're confirmed, once they break out and prove to be a double top. And I'll tell you why, because there's a lot of things that look like double tops before they are one. Let me see if I can get this to pull here. For instance, right here is a good one. When this was coming up, this looks like a double top. But the reason why you want to let it break the uptrend line is because the trend is more likely to continue than it is to reverse. So most of the instances where something will look like a double top or a double bottom, you'll actually see that trend continue on and break out into higher highs. So it's really just a move up, a consolidation, and then a push higher. So the way that you distinguish from what appears to be a false double top and a true double top is by allowing it to go ahead and break the trend line. Another way that some do it is to take and make it a more conservative approach, make it break the double bottom in the M-shaped double top there. So that means you would extend this out, and then once it goes out into the future short as soon as it breaks that bottom. So there's two different ways. More aggressive way is to, as soon as it breaks the trend line. More conservative way is to short it right when it breaks through this bottom here, which shows that it's broken a whole range. So it's broken not only the uptrend, but it's broken the sideways range and is headed downward. And you'll see pretty decisive, quick move typically when that happens, because then a lot of people are aware that the trend move has changed and they've gotten stopped out of their positions or reversed out or margin called out. In other words, or what I mean by reversed out, I mean they've had to go from being long to flipping and being short, things of that sort. Okay, the next thing is this started coiling up into a symmetrical triangle pattern on the pound yen daily chart, and once you get a couple of points that are you've got higher lows on a couple of points, and once you have lower highs on a couple of points, you can project these lines out into the future. So pretend like all of this from these couple of points on doesn't exist. So past point B, let's just pretend that the market is not there and it has not traded in any of that yet. This gives us some boundaries in the future that we can look to. The conservative trader can buy it anytime that it gets close to the bottom line, and you can place a stop, comfortably outside of that range, because sometimes you can get some weird spikes. Conservative traders will go with fewer lots and a wide stop. An aggressive trader should probably not go with too many lots for sure, but definitely might take that conservative number of lots and use a tighter stop as well. And then when it trades up to the top of the range, when it starts getting towards the top here, you could sell, and then you could reverse your stance, your position there, and short near this top of this triangle. Take your stop up here, somewhere well outside of the triangle, and allow it to trade down towards the next bottom. Now, here's something interesting. In an Elliott wave, they talk about an ABCDE pattern is what they call these. They don't call them triangles. And I find the interesting part of that, and a point to that, is that most of these triangle patterns will have typically at least 5 turning points. So once it comes well into the pattern and starts it after its first recoil back against the main trend that it was in, it'll typically have at least 1, 2, 3, 4, and then 5, which is the breakout. So if you include the initial start, you got about 5 turns in different directions within the pattern, and then you have a breakout. So the pattern, of course, initially, until you get your first couple of points that form, is a little tougher, but all of this area in here is fairly conservative, fairly easy trading. And so you have very good points of where this thing's probably going to stop once you're in a trade, and about how far it's going to go. You know about where you would reverse and about where it would go there. Now sometimes they'll go very quickly to that other side, and other times they'll meander and work their way eventually over to the other side. So these are places to exit once you start nearing the edge. Now, does it have to go all the way to the edge? Sometimes it might be just a little bit shy of it. So a lot of times you'll want to exit your position just a little bit before it gets to the very edge. Now, one thing I want to also show you about these triangle patterns is that a lot of people think, well, I've got to get in just exactly when that pair hits the edge or whatever. But what I want to show you is that, and I want to bring out, is that these patterns are known to hang around these areas for some days once they hit. So it goes up to this area and it hangs out, and you get several stabs in this region before it really takes off and heads towards this other side. And then here you've got 3 days where there's trading activity down towards this bottom line. So many times if you see this market come down and it hits and touches that line and you missed it, guess what? You've probably got at least one more day, if not another one or more, to where it's going to come back down in that vicinity to where you can hop in your long. Then it comes up, doesn't make the full cycle, so it comes back and actually somebody gets a shot at it again before heading over to the other side. Again, we have 2 days here. The first day it hits it and tags it, and then the second day it tags it a little after the first day and then starts to reverse. Now notice though, it comes back and gets within the vicinity again here, within the vicinity again here, and within the vicinity again here before it actually takes off and heads to the other side. So sometimes you'll be very fortunate in that it'll meander around one of the edges before it really takes off. Other times it'll spend a couple of days and head around and jolt backwards. So just know that you don't have to get in the very second it hits. You can actually wait and make sure it holds there a couple of days sometimes if you want to as well, to be more conservative, to make sure it's not going to be the break. But typically when you start trading these earlier on, you'll have profit from from here to here. That's the first time that a triangle has been very distinct, and you'll have profit from here to here. So you've got a good bit of profit going into these. Now where it starts getting tricky is in your final turn or two. So you want to make sure you're using those stops very good, and keeping your stops a little tighter outside of your triangles usually at that point, because you're going to get a directional break. Statistically, there's more higher odds for the pair to break out in the direction that it came into the triangle in. So if we come down into the triangle and it starts triangulating up, it's more likely that it comes down out to the south of this triangle and breaks out. However, that is just statistics and probabilities. In other words, more times than not it will do that, but it does not mean every time it will be that way. So you have to be ready for a breakout on this side as well. And then on our next shot, I'll show you what breakouts actually look like after a pattern. Let's take a look here, and let me blow this up. This is the pound Aussie on the 1 hour 30-day chart. And you've got an ascending triangle. All triangles, whether they're ascending, descending, or symmetrical, mean the same thing. You've got a sideways range, you've got a sideways consolidation. Here's one of those instances that I'm talking about. Statistically, since this comes up from an uptrend and consolidates, statistically it's more likely to break out to the upside. However, they all will not do this. This is one of those instances, and this is why you want to be ready to trade a breakout to the south side as well, because you actually got a true top and reversal here. It came up and hit it once, twice, 3 times, 4 times if you count the spike, and then breaks out. But again, when you're forming the ascending triangle, look here, 1, 2, 3, 4, 5, 6. You can count this 7 if you want to count that spike, or you can just say 6 full turns. Either way, I wouldn't argue with either point, and then it breaks out. So, I want to emphasize a couple of things, that when these triangles start forming and you've seen a turn or 2 or 3 happen, all is not lost. Actually, you've still probably got 2 or 3 more distinct moves left. And the nice thing about these trades being inside the triangles is that they're more conservative and they can be counted on quite a bit better. The breakout, once that happens, again, like I say, you may have been in a trade and get stopped out and have to reverse and take that trade, or you may have been out of the trade after you've made a few turns and you wait for the breakout to occur and then hop back on once you see which way this thing breaks out. Also know that with a lot of breakouts from patterns, almost any pattern, I don't care if it's head and shoulders or any of these triangles or whatever, many times the pair will break out and come back, trade back towards that pattern, and then launch out again. Sometimes they do not. Either way, if they do or they don't, don't be alarmed though. I guess my biggest point is don't be alarmed if they break out and then pull back to the pattern. That's very common, very common. So you would want to, in these cases, you would want to, as soon as the candle closes outside of the pattern, you would want to trade, so you could be in short there, and this yellow line would be our stop. You would want to have your stop well back in this pattern, probably about halfway in your triangle. Keep in mind that your pair is likely to go about at least the distance, number of pips wise, of the open end of the triangle from the point that it breaks out. So look at this width and look at this width, and you'll see that you have a good risk to reward ratio, even by giving this trade plenty of distance by having your stop in the middle of the triangle. So because you're going to come way down here minimally for your target. But remember, this could break out, and then it could, let me say it again. It could pull back to the pattern, and then head south to its target. So don't be alarmed. Don't doubt yourself when that happens. It very much can happen, and that's why you want to make sure that you give the stop plenty of room. So these are the type things, just one of the type of strategies that I use in the Currency Cross Trader service. There's literally thousands of subscribers that hop on board with us on exact trades, where I give exact entry prices, exact stops, and exact limits of where to exit. So once you put a trade on, you can just let it go until a stop or limit is hit. Now sometimes we will make an adjustment to that trade. Let's say that, for instance, we were in this trade and we had entered here and the stop was here. If it's moved all the way down here, then we may very well I may very well issue a recommendation to move the stop a little past our entry point. Now, why would I do that? One, it takes all the risk out of the trade to where I basically have ensured that I would not have a losing trade, because I would have at least a little bit of profit to work with. Yet I've given the trade plenty of room to move as well. So if anything, you'll usually get a stop adjustment if it when it's moving in our favor, but that's usually about the only other order that you'll see. Other than that, we just let a stop or limit hit, and we just take high probability trades. We don't trade every day. We'll put on a trade about every week or two, and allow it to go for a week or two. Typically is very typical. Some trades could go a little longer if they're still working in our favor. Some trades could go a little shorter, only if the market just moves very fast and hits our stop or limit. So this is not a day trading service where you've got to just hover over your position. You can actually have a real job and be in this service, and that's what I like about it, and that's why I feel that it's for many people like that. So anyway, that is the chart of the day, and I hope that you got a lot out of it. I sure enjoy teaching these. I appreciate the emails I get, by the way, and the testimonials, telling me how much you enjoy the chart of the day, how much you learn from it, and how much we've gotten testimonials that say they learn more from these chart of the days than they've even had from organized Forex courses before. So I really do appreciate that. I spent a lot of my career as a Forex instructor, so I talk in simple concepts. I don't use a ton of industry jargon, or if I do, I explain it. And that's exactly how I do in the Currency Cross Trader service. So it doesn't matter whether somebody's got a background in Forex in this industry to understand my newsletter and understand my trading recommendations, because I keep it simple. To me, if you know a topic well, then you can drill it down to its lowest common denominator. You can simplify it. And so that's the name of the game for me, is not really trying to impress people, but really trying to keep things simple for people, so that you can enjoy the letter, you can enjoy the trades, and it keeps them fun. All right, thanks so much for watching. Bye bye.